Hello guys. So this is the second part of our RTP discussion. In the first part, I have already discussed with you the case study based MCQ. In this part, we'll take up some of the descriptive questions. All right. So I'm starting off with question number 6. Before we start question number 6, I want to discuss one small concept which is involved in this question and then we'll read the question. See, listen, think about your residential status chapter. Okay. In that chapter, total income minus income from foreign sources. The balance income should be more than 15 lakhs. This condition you have come across in how many places? In residential status chapter. In 2 places, guys. Place number 1. If you want to apply the special provision, I call it the special provision. If you wonder what it is, it's nothing but your 120 days criteria, that provision in basic condition to 120 days. So if you want to apply special provision, you apply this criteria. Also, if you are thinking if the assessee is deemed resident or not, there also you have this criteria. So when you say total income minus income from foreign sources, this should be more than 15 lakhs. This calculation is relevant in these 2 places. Number 1, special provision, the provision where you apply the 120 days criteria instead of 60 days. And second place is deemed resident. Okay. Now, in these 2 places, when you're doing this calculation, listen carefully. Total income minus income from foreign sources is nothing but income from Indian sources, guys. Income from Indian source means what? It means an income which is earned in India, or income which is accrued in India, or income which is arising in India, or income which has a source in India. Right, guys? Listen to me very carefully. This point is something which, in the last few examinations, if you see, they are correctly targeting this point, and many students are not even aware of this particular point. So listen as carefully as you can, take it as a challenge. In one explanation itself, you have to grasp it. Income from Indian source generally means this income which is earned in India. But for the purpose of this calculation, what did I say? Just for the purpose of this calculation alone, income from Indian source will include 3 things. I'll repeat one last time. Generally, income from Indian source is only an income which is earned in India. But for the purpose of this 15 lakh calculation alone, only for the purpose of this calculation, income from Indian source will include 3 things. Only for the purpose of this calculation. Okay, what are the 3 things? This is the first thing I've already told you. Second thing, any business income from a business which is controlled from India. Any business income from a business which is controlled from India, or any professional income from a profession which is set up in India. Understanding. So generally income from Indian source means an income which is earned in India, but only for the purpose of this 15 lakh calculation alone, income from Indian source will also include business incomes from businesses controlled in India and professional incomes from professions set up in India. Remember this one point. This is a main key point in this question. All right. With this in your mind, now let's start reading the question. The question says Mrs. Sarika, an Indian citizen. Okay, she's an Indian citizen. She's in employment with an overseas company located in UAE. So she's working in UAE. She is not liable to tax in UAE. She is not liable to tax in UAE. As soon as you see the sentence, deemed resident concept is what comes to your mind. She is not liable to pay tax in UAE. So you're connecting it with the last condition of deemed resident, that she's not liable to pay tax in any country. We'll understand that as I go to the deemed resident concept in some while. Patience. During 23-24, she comes to India for 121 days. She was in India for 50 days, 100 days, 76 days, 145 days in last 4 years. So they've given the 4 years. Her annual income is as follows. Mrs. Sarika has opted out of the default tax regime under 115 BAC. Opted out, which means is your assessee following 115 BAC, guys? No, normal provisions. From the information given above, determine the residential status and total income of Mrs. Sarika. Simple, guys. One by one, we'll take it up. They're asking us to find the residential status and total income. Please keep in mind, assessee has opted out of 115 BAC, so normal provisions only. First of all, they're asking us to check her residential status. Now, in residential status, I will of course first of all give priority to special provision. Special provision is nothing but your 120 days provision, but I can apply that provision only if some conditions are fulfilled. Condition number one is that assessee must be an Indian citizen or assessee must be a person of Indian origin. Yes, assessee is an Indian citizen. Condition one fulfilled. Second condition is that the assessee must have visited India in the previous year. Now, did your assessee visit India in the previous year? Yes. The question says she comes to India for 121 days and then she goes back. So, yes, she did visit India in the previous year. The third condition is that the total income minus income from foreign source should be more than 15 lakhs. Now, this we'll have to calculate. Total income minus income from foreign source means what? It means income from Indian source. Now, income from Indian source generally means what? Generally means it is an income which is earned in India. But just now I told you, for the purpose of this 15 lakh calculation, income from Indian source means three things, guys. Number one, income which is earned in India. Number two, incomes from businesses which are controlled in India. Business incomes from businesses which are controlled in India. And professional incomes from professions which are set up in India, guys. So even this will be considered as income from Indian source. Business income from a business which is controlled in India. Professional income from profession which is set up in India. This calculation we'll have to do and see in this question. See, come on, let's see one by one. Salary accrued or arisen in UAE. Salary is accrued in UAE. So this is accrued in UAE, accruing outside India. It is not earned in India. It is not business income. It is not professional income. It is salary income. So this I will not consider, guys. For this 15 lakh calculation, I will not consider. See, I'm not doing total income calculation. Don't misunderstand this. What am I doing? I'm checking whether this condition is fulfilled or not. If this condition is fulfilled, then the 120 days criteria, that provision will apply instead of 60 days provision. You're getting my point. So I'm not doing total income calculation. I am just checking whether this condition is fulfilled or not. Income accrued and arisen in India, 2 lakhs. Will I consider this? Yes, it is accruing in India. It is earned in India. So this 2 lakhs I will consider. Then, income deemed to accrue and arise in India. Yes, even this income is earned in India. So even this 7 lakhs I will consider. Then, income arising and received in UAE from a business which is set up in India. Business income from a business which is set up in India or controlled in India. Even this 5 lakhs I will consider, guys. But which bucket will it fall under? It is not earned in India. It is arising and received in UAE. So it is earned in UAE, it is received in UAE. But it is from a business which is controlled or set up in India. So business income from a business controlled in India, under this bucket I will consider this 5 lakhs. Understanding, not earned in India, under this bucket. Business income from a business controlled in India. And then life insurance premium paid by check in India. This is ATC. So even this I will consider ATC 1 lakh. All right. So what is the net number over here? If you see the net number, first of all, considering the first three transactions is going to be 14 lakhs minus 1 lakh ATC. So here you will get 13 lakhs, guys, which is within 15 lakhs. So this condition is not fulfilled. Now see, in this discussion, you would be having two places where you're little unsure about. Why did I deduct ATC? See, understand, are we computing income here or are we computing total income over here? We are computing total income less income from foreign sources. We are computing income from Indian sources. This income from Indian sources is total income from Indian sources. You're understanding? Total income from Indian sources, total income, guys, which means I have to consider chapter 6 here also, right? So total income from Indian sources, I'm not talking only about income which is earned in India. For this purpose, income from Indian source includes three things. But because it is total income, I have to consider chapter 6A also. So this is only 13 lakhs within 15 lakhs. So third condition is not fulfilled, guys. So therefore, I can't apply the special provision. I can't apply the 120 days criteria. So therefore, I have no choice but to apply the regular provision. Now, what does regular provision say? Basic condition 1. In the previous year, did the assessee stay in India for at least 182 days, guys? In previous year, the question says assessee stayed in India for only 121 days. So basic condition 1 is not fulfilled. Then comes basic condition 2. But regular provision, basic condition 2, pause, check, think. Tell me, is your assessee an Indian citizen who is leaving India in the previous year as a crew member of an Indian ship? No. Second point, is your assessee an Indian citizen leaving India in the previous year for the purpose of taking up an employment outside India? No. Third, is your assessee an Indian citizen or a person of Indian origin who is visiting India in the previous year? Yes. So, assessee is an Indian citizen visiting India in the previous year. So, basic condition 2 is going to be not applicable for the assessee. So, basic condition 1 not fulfilled, basic condition 2 not applicable. So, what will you conclude? Assessee is non-resident. Now, once assessee is a non-resident, next what do you think about? You think about deemed resident. But deemed resident has its own 4 conditions. Condition number 1, assessee should be an Indian citizen or person of Indian origin. Condition number 2, assessee's total income minus income from foreign sources should be more than 15 lakhs. Condition number 3, assessee must be a non-resident. And condition number 4, assessee should not be liable to pay tax in any country. See, over here, can you please identify a mistake which I've purposely put in the 4 conditions? There is a mistake. And the mistake is about person of Indian origin. In deemed resident, we only have Indian citizen criteria. We don't have person of Indian origin criteria. Remember this very common mistake which we see students make in the exam also. Deemed resident, only Indian citizen criteria, no person of Indian origin criteria. Okay, yes, assessee is Indian citizen. But is total income minus income from foreign sources more than 15 lakhs? No. This is only 13 lakhs. We've already done the calculation over here. So this criteria is not fulfilled. So even one criteria is not fulfilled. Assessee is not a deemed resident. So what is my assessee now? Non-resident. So because assessee is a non-resident now, what is the scope of total income, guys? What are the incomes which should be taxable? Only 2 incomes will be taxable. Number 1, incomes which are earned in India, or you can say sources in India, or you can say received, accruing in India, or you can say arising in India. And number 2, incomes which are received in India. So only these 2 incomes will be taxed for the assessee. Alright guys, so with this in our mind, now can we start computing the total income? Because they asked us to check residential status and compute total income. Residential status we have concluded. Assessee is a non-resident. Now what about the total income of the assessee? And also keep in mind, assessee opted out of 115 BAC. So let's compute. What are all the incomes? Salary accrued or arisen in UAE. Where is the source of this income? Source is outside India, guys. And where is it received? They did not say where it is received. So when they don't say where it is received, we assume that it is received in the same place where it is accruing. It is accruing outside India. So let's say receipt also outside India. This becomes a foreign income, guys. This will not be taxable for my non-resident assessee. Then, income accrued and arisen in India. Here, if you see the source of this income, it is in India. So, therefore, this becomes an Indian income. So, this is going to be taxable for my assessee. So, I can consider this 2 lakh rupees. Yes, guys. Then, income deemed to accrue and arise in India. Even this income, the source is in India. So, because the source is in India, the 7 lakh again becomes an Indian income. And even this is going to be taxable for the assessee. I can consider the 7 lakhs also. Then, what about the next one? Income arising and received in UAE from a business set up in India. Where is the source of this income, guys? It is arising in UAE. So the source is outside India. It is received also in UAE, received also outside India. It becomes a foreign income and I will not consider this income for my non-resident assessee. See, do not get confused. What we did over here, this calculation was only to check this 15 lakh criteria. Okay, generally, when do you consider income from business setup in India, income from profession setup in India? Only for R NOR, not for NR and not for NR, right? Only for R NOR. So that is why assessee is NR over here. So because assessee is an NR, I will not consider this in the scope of total income. You're understanding? Don't think, see, I'm not contradicting at all. Over here, I did consider this income. But now in my total income computation, I am not considering this income. Understand that there are two different calculations. This calculation I did only for this 15 lakh criteria. Only for this 15 lakh criteria alone, income from Indian source includes these three things. Also includes business income from businesses controlled in India. But now that I have concluded my assessee is NR, only Indian income is taxable, guys. But this is clearly a foreign income because source outside India, also received outside India. Therefore, I did not consider. You understood? Two separate concepts. Don't mix them up. And lastly, we have life insurance premium paid by check in India, ATC. So the GTI of the assessee is going to be 9 lakh. From this, we'll subtract section ATC chapter 6A. How much? 1 lakh. Well within the limit of 1,50,000. So 8 lakhs. This becomes the total income of the assessee under my first situation. Understanding? Yes, in case you're wondering, even non-resident assessees can enjoy ATC. ATC assessee has to be individual or HUF. Okay, resident, non-resident and all doesn't matter. So even non-residents, yes, they can claim ATC. Alright guys, so till now what was your learning? Your biggest learning till now was how did we do the 15 lakhs calculation? Okay, now this was it about my first subdivision. Then they're asking us what would be your answer if income arising and received in UAE from business set up in India. This point basically. Income arising and received in UAE from business set up in India is 10 lakh instead of 5 lakhs. So here instead of 5 lakhs, what if this was 10 lakhs? Then would there be a change in the answer? Let's discuss that guys. So again, same thing, we have to check the residential status and we have to compute total income. Residential status, same procedure guys. I will first try to apply special provision, that is a 120 days criteria. But I can apply that only if conditions are fulfilled. So condition number 1, assessee should be an Indian citizen or a person of Indian origin. We've already spoken about this, assessee is Indian citizen. Second condition, assessee must have visited India in the previous year. We've already checked this, yes, assessee has visited India for 121 days. Third condition, total income minus income from foreign sources should be more than 15 lakhs. That is, I'm talking about income from Indian source. And I've already told you, generally income from Indian source means income which is earned in India. But only for the purpose of this 15 lakh calculation alone, income from Indian source will include three things. Now let's check what is the income from Indian source for the purpose of 15 lakhs number. So here if you see, everything else is the same, only this number has changed guys, only this 5 lakh number has changed to 10 lakhs. So all of this is going to be exactly the same, only one number has changed. Instead of the 5 lakh number, we will take the 10 lakh number guys. The 5 lakh number was this, right? Business income from a business which is set up in India. We are considering that no business income from businesses controlled in India. See, don't bother too much about the interchange of these two words in this question. It is fine. Alright, so instead of 5 lakh, 10 lakh. So now if you see 2 lakh plus 7 lakh plus 10 lakhs, you will get 19 lakhs here. Minus 1 lakh ATC, you will get 18 lakhs here, which is more than 15 lakhs guys. So which means third condition also is fulfilled, which means you can apply the special provision. So basic condition 1, in the previous year did the assessee stay in India for at least 182 days? No. Remember, assessee stayed in India for only 121 days. So 182 days criteria is not fulfilled. Basic condition 2, should I pause, check, think? No. All that we do only in regular provision. In special provision, basic condition 2 will always apply. What is basic condition 2? Previous year assessee should have stayed in India for at least 120 days, and 4 preceding previous years put together, assessee should have stayed in India for at least 365 days, guys. So 120 days criteria, yes, this is fulfilled. But what about this 365 days criteria? Let's check, guys. Last 4 years, how many years? How many days? 50 into 100, 50 plus 100 plus 76 plus 145. This is 371 days, guys, last 4 years. So 371 days, even this condition is fulfilled. So basic condition 2 is fulfilled, guys. So because basic condition 2 is fulfilled, I can say that my assessee is a resident. Now, once the assessee is resident, I will have three additional conditions to check whether assessee is ROR or RNOR. Special provision, three additional conditions. First additional condition is that the basic condition 1 should be fulfilled. Second additional condition is that 7 preceding previous years assessee should have stayed in India for at least 730 days. Third additional condition is that at least 2 out of 10 preceding previous years assessee should be a resident. Now here if you see, basic condition 1 is not fulfilled. So which means additional condition 1 is not fulfilled. Even one additional condition is not fulfilled, assessee becomes RNOR. So, in the second part of my situation, assessee is RNOR. Why RNOR? Resident, you understood. One additional condition is not fulfilled. Basic condition 1 is not fulfilled. So, first additional condition is not fulfilled. So, therefore, your assessee becomes an RNOR. Now, if the assessee is RNOR, what is the scope of total income, guys? What kind of incomes are taxable for the assessee? Number one, Indian incomes. Indian incomes means what? Incomes which are earned in India, incomes which are received in India. And number two, apart from this, business incomes from businesses which are controlled in India, and professional incomes from professions which are set up in India. Even this will be taxable for the assessee. Get understanding? So this is about your RNOR's scope of total income. So we've concluded assessee is RNOR. Now let's do the total income computation. Please keep in mind, assessee has opted out of 115 BAC. So normal provisions only we are applying. So come on everybody, let's do the thinking regarding the total income computation. The first transaction, salary accrued or risen in UAE. So this income, if you see, the source of this income is outside India. Received also, let us say outside India. This becomes a foreign income, not taxable for my RNOR. Second, income accrued and arisen in India. Here if you see, yes, the source is in India. It becomes an Indian income. Indian income is taxable for all my assessees. So this 2 lakhs, yes, it will be taxable. Third transaction, income deemed to be accrued and arisen in India. Even here if you see, the source is in India. So even this becomes an Indian income. So even this 7 lakh will be taxable for my RNOR assessee. Then this is interesting. This, remember, for this purpose we changed it to 10 lakhs. Now see, income arising and received in UAE. So where is the source? The source is outside India and it is also received outside India, but it is from a business setup in India. So it is a business income from business controlled in India. At this point it will fit in under. So this 10 lakh also you will consider for your RNOR assessee. For NRSSC, we will not consider, but for RNOR, we will consider because business income from a business set up in India. So therefore, right now, if you see, the GTI of your SSC is going to be 19 lakhs, okay? And from this, we will subtract our Chapter 6A ATC. We have life insurance premium of 1 lakh. So the net answer of the SSC, 18 lakhs, this becomes a total income. Are we understanding? Yes, so this was a second subdivision. So now coming to the third question over here, in continuation to point 2. So in continuation to point 2, what would be your answer if Mrs. Sarika comes to India in 22-23 for 45 days instead of 145 days? So in 22-23 it was 145 days. Instead they are saying what if she comes to India for 45 days? Then how would the second answer change? See, I'll do the corrections over here itself. In the third situation, only one thing we are changing. Instead of 145 days, she's coming to India for 45 days, that too in 22-23. Okay. So all this is not going to change, guys. We're not changing any income numbers. Basic condition 1 is still not fulfilled, because in previous year only 121 days. So only basic condition 2 for preceding previous years, only this will change. So for preceding previous years, how many days has she lived in India now? 50 days, 100 days, 76 days, 45 days, only 271 days, guys. So which means basic condition 2 is now not fulfilled. Right? For preceding previous years, 365 days not fulfilled, only 271 days. So neither of the basic conditions are fulfilled. So therefore, what will you conclude? Therefore, you will conclude that she is a non-resident. Now, because she's a non-resident, you will think about deemed resident. Deemed resident, remember we put over here itself 4 conditions we had put for deemed resident. So I'll put down the conditions for you once again. Condition 1, assessee should be Indian citizen, fulfilled. Condition 2, total income minus income from foreign sources should be more than 15 lakhs. Remember, we've already done that calculation in the second part. It was 18 lakhs. So even this is fulfilled. Third condition, assessee should be non-resident. We've already concluded that as well. And fourth condition, assessee should not be liable to pay tax in any country. The question very clearly says that she's not liable to pay tax in UAE. She is earning income either in India or she is earning income in UAE. She is not liable to pay tax in UAE. She is not liable to pay tax in any other country. Even this is fulfilled. Guys, all my conditions are fulfilled. Assessee is deemed resident, and because assessee is deemed resident, assessee becomes RNOR. Understood? Very interesting concept. Multiple points from your residential status chapter have been revised for you over here. So assessee is a deemed resident, assessee becomes an RNOR, and for RNOR, what's the total income? We've already concluded for RNOR the total income is 18 lakhs. We have already done that calculation. You got it. So in my first subdivision, assessee was a non-resident. We applied the regular provision. In the second situation, we applied the special provision. Assessee was RNOR. Third situation, assessee is deemed resident. Deemed resident will automatically become RNOR. So that is it with your first question. Understanding? So through our first question, our major learning was how do we do the 15 lakhs calculation. Okay, so I'll close this question here and I'll take you to the second question. Through this question, we're going to be doing salaries computation. It's a basic salaries chapter question. It has around 8 subdivisions. They're asking us to compute the total taxable salary of Mr. Anshul if he has shifted out of the default tax regime. Shifted out of the default tax regime means 115 BAC he is not following. Okay. So we just have 8 subdivisions over here. Let's do this question. It's a pure salaries based question. Remember, assessee has opted out of 115 BAC. Let's take the adjustments one by one. First of all, basic salary is 75,000 per month. From 1st December 23, it is 85,000 per month. So April, May, June, July, August, September, October, November. For 8 months, it was 75,000 per month. And for the remaining 4 months, it is 85,000 per month. Okay. So basic salary, let's do our math, guys. Basic salary is 8 months, 75,000 per month. And the remaining 4 months, it is 85,000 per month. So do the math. How much does it work out to? You get 9,40,000 rupees. Yes, so this is the basic salary of your assessee. Then the next adjustment, DA is 50% of basic salary and 40% of DA is forming part. So forming part, I will not bother about that right now. Total DA of the assessee is 50% of the basic salary. So 9,40,000 into 50%, that's going to be 4,70,000. All right, guys, this is also done. Then entertainment allowance is 10,000 rupees. Entertainment allowance is fully taxable. Entertainment allowance, you will get section 16 deduction only if assessee is a government employee, central government or state government employee. So if assessee happens to be a government employee, then assessee will get section 16 deduction of entertainment allowance. And how do you compute the deduction, guys? 3 things you will calculate. Number 1 is 5,000 rupees for that particular year. Number 2 is 20% of basic salary. And number 3 is actual entertainment allowance. So out of these 3, you will pick whichever is lesser. Good. Whichever is lesser, that will become a section 16 deduction. But this deduction you will get only for government employee. And assessee is not a government employee. So therefore, no section 16 deduction. And one more thing, remember, in case assessee was following 115 BAC, if assessee follows 115 BAC, in that case, under section 16, assessee will get only standard deduction. No professional tax deduction, no entertainment allowance deduction also. Okay, just wanted to give you a revision now. Come to the fourth point. Contribution of employer to RPF account of the employee is 18% of basic salary. Let's handle till here, guys. So we are having employer's contribution to RPF Let's give reference to working note number 1. Let's open working note number 1. This working note is regarding what? One second. Yeah, so this working note is regarding employer's contribution to RPF. Now, how do you do the computation? I always tell students employer's contribution to RPF. Remember the small tip 4 plus 1. 4 plus 1. So 4 steps plus 1 step. That is how you do your employer's contribution to RPF working note 4 plus 1. If you remember like this, you just won't miss a mistake. You just won't miss a step. You just won't miss a step. You'll get all your step marks and you're literally hand holding the examiner through your answer paper. And that is what we want. So what is this 4 plus 1? Listen, your first step is going to be computing salary for the purpose of RPF. Salary will have 3 components, guys. Basic salary, then DA forming part of salary for retirement benefits, and employees turnover based commission. Basic salary, we've already done the computation. Basic salary is 9,40,000. DA also, we've already done the computation. DA is 4,70,000. But how much of this DA is forming part? The question says only 40% of this DA is forming part. So 4,70,000 into 40%, which will be 1,88,000. And there's no commission. So the total salary for the purpose of RPF will be 11,28,000. Your first step. Your second step is going to be the actual contribution of the employer. How much did the employer actually contribute? The question says employer contributed 18% of basic salary, guys. So basic salary is 9,40,000. That into 18% is what the employer has actually contributed, which is 169,200. Then the third step is going to be the exempt contribution. How much is going to be exempt, guys? 12% of this salary. So 11,28,000 into 12%. 11,28,000 into 12%, which is 135,360. This is exempt. So obviously step 4, what's going to be a taxable contribution? Taxable will be received minus exempt. So you received how much? 169,200, out of which 135,360 is exempt. So what is your taxable contribution? 33,840. This is your taxable contribution. Okay, so these are your first 4 steps, but plus 1 I am saying. So what is this 5th step? This 5th step is, you have that point right. I will see what is employer's contribution to RPF plus superannuation fund plus NPS. Put together, is it more than 7,50,000? If it is more than 7,50,000, then whatever is the excess will be taxable as perquisite. Then on this excess, whatever interest you have earned, even this interest will be taxable as perquisite. See here in this question, this point will not apply because the employer's contribution is only 169,200, which is within 7,50,000. But the reason why I am still putting it down over here is generally when it comes to employer's contribution, till here perfectly students do. But this particular 7,50,000 point in that examination environment, in the middle of all that stress, we tend to forget this point. So that is why if we learn it as 4 plus 1, we will know that, okay, there is something else also which I have to think about. So these little tips are what will ensure that you maintain accuracy in the examination. So remember to check this last point, that is the total contribution more than 7,50,000. If it is more than 7,50,000, whatever is the excess will be taxable as perquisite. Even interest on the excess will also be taxable as perquisite. In this question, this will not apply because it is not more than 7,50,000. Okay, so what's the total taxable employer's contribution now? 33,840. We've already done this checking also. Then the question says, employee also contributed equivalent amount. What do I do with employee's contribution, guys? Employee's contribution goes to section ATC. But we're not calculating chapter 6A over here. So I can ignore ATC. And one more thing is, employees contribution, right, if it is more than 2,50,000, if employees contribution is more than 2,50,000, then I will check what is the excess. I will not tax the excess. I will check what is the excess above 2,50,000. On this excess, what is the interest earned? This interest is going to be taxable. Yes, for employer's contribution, we'll see is it more than 7,50,000. If it is more than 7,50,000, the excess is also taxable. Interest on the excess is also taxable, isn't it? But for employee's contribution, we will see is it more than 2,50,000. If it is more than 2,50,000, we will see what is the excess. We will not tax the excess, but on that excess, whatever is the interest, that interest on the excess, that is what we will tax. Okay, but here all that doesn't apply because within 2,50,000. Okay, then comes the next point. Professional tax paid 2,200, out of which 1,800 was paid by the employer. So professional tax, let me give you one quick revision of the concept. We will see what is the professional tax amount. Okay, out of the professional tax amount, what is the amount paid by employer and what is the amount paid by employee. Like here, if you see, the professional tax is 2,200. So out of this, how much is paid by employer? 1,800 was paid by employer. So obviously, the balance 400 is paid by employee. So now, whatever is paid by employer, okay, this is going to be taxable as perquisite. And the entire professional tax, whether paid by employer, whether paid by employee, you will get section 16 deduction provided assessee has opted out of 115 BSE. Right guys, this is a provision. So whatever is paid by employer, this is taxable as perquisite, and the entire professional tax, whether paid by employer, whether paid by employee, the entire professional tax is section 16 deduction. So now if you see, there are going to be two tax treatments. So first of all, we will tax it as perquisite. How much? Whatever is paid by employer is 1,800. Later, when we compute section 16 deductions, we will remember to give 2,200 section 16 deduction for professional tax. Alright, then comes our next adjustment, everybody. Our next adjustment over here with respect to the sixth adjustment, HRA. So the question says HRA of 16,000 per month. He paid rent of 17,000 per month for accommodation in Meerut. So let's do the HRA adjustment. HRA, let's give reference to working note number 2. So after my working note number 1, I'll open working note number 2 for HRA. Now for HRA, there are going to be 4 steps, guys. In employer's contribution to RPF, I said 4 plus 1. No, here 4. Okay, so the first step and the second step will be the same. What is the first step? The first step will be computation of salary. Second step will be actual HRA. But wait, in HRA, in RFA, if there's any change in between the year, we split the year, guys. If there's any change like change in rent, change in salary, change in HRA amount, we split the year. Here, if you see, basic salary changed for me. Till November it was 75,000. December onwards it was 85,000. So there is a change in salary for me. So I will split the year. We split the year for HRA and for RFA. Okay. So I will do one calculation for April to November and I will do one calculation for December to March. Understood? 8 months, 4 months. Why am I splitting? Because salary is changing December onwards. So my first step is going to be computation of salary. So salary will have how many components? Same 3 components, guys. Basic salary, DA forming part, and lastly employees turnover based commission. So what is the basic salary of my SSE? Till November, it is 75,000 per month. So 75,000 into 8, 6 lakhs. And December to March, it is 85,000 per month. So 85,000 into 4, which is 3,40,000. Then how much is DA forming part? Question says DA is 50% of basic salary and 40% is forming part. So 50% of basic salary and 40% is forming part. So 1,20,000 here and 3,40,000 into 50% into 40%, 68,000 here. And we've already seen that there is no commission. So what is salary for the purpose of HRA? You have 7,20,000 here and we'll have 4,08,000 over here. So this is our salary computation for the SSE, for the purpose of HRA. First step. 4 steps, this is the first step. Then comes the second step, which is actual HRA. How much HRA did your SSE actually receive, guys? Question says HRA 16,000 per month. So 16,000 into 8, assessee has received 1,28,000 here. 16,000 into 4, 64,000 over here. Then comes the third step, which is exempt HRA. How do you compute exempt HRA? Assessee will have some exemption only if assessee is paying rent, guys. First of all, is your assessee paying rent? Yes, he is paying rent. So which means assessee will have HRA exemption. So you will compute three things. Out of the three things, you will pick whichever is less. Whichever is less will be what? Whichever is less will be exempt or taxable. Whichever is less will be exempt. So what are the three things? First is 50% of salary or 40% of salary depending upon metro, non-metro. Assessee is living in Meerut. Meerut is not metro. So therefore 40% of salary. So 1,28,000 into 40%, 51,200 here. 64,000 into 40%, 25,600 over here. What's the second point, guys? Second point will be actual HRA. We've already done that math over here. 1,28,000 and 64,000. Lastly, rent paid minus 10% of salary. How much rent is my assessee paying? Rent is 17,000 per month, guys. So 17,000 into 8 minus 10% of salary. So minus 72,000. That's going to be 64,000 here. Then 17,000 rent paid into 4 months. Minus 10% of salary. So minus 40,800. That's going to be 27,200 here. So I have to pick whichever is the least, that is 51,200 here and 25,600 here. Please don't take these numbers to the main answer. This is only exempt HRA. What do we need? Taxable HRA. Taxable HRA will be nothing but received minus exempt. Nothing but step 2 minus step 3, guys. Step 2 minus step 3. So received is 1,28,000, out of which 51,200 is exempt. So 76,800 will be taxable here. And here if you see 64,000 is what I received, out of which 25,600 is exempt. So the balance 38,400 is taxable. So if I were to ask you, what's a total taxable HRA? What would you say? Total taxable HRA, 1,15,200. Simple 4 steps, guys. First step, I'll compute salary. All right. Second step, I will compute the actual HRA. Third step, I will see how much HRA was received. And last would be my taxable HRA. We've made one small mistake over here in the 40% calculations, because of which we'll have to redo a little bit. All right. So 40% of salary. So 7 lakh 20 into 40%, which will be 2,88,000 here. 4,08,000 into 40%, which is 163,200. Now, if I look at the lesser number, it's going to be 64,000 here, and here the least number is 27,200. Right, guys? So now what's going to be your taxable HRA? Received minus exempt, 1,28,000 minus 64, which is 64,000. And 64,000 minus 27,200, which is 36,800. So total taxable HRA will be 1,08,000. So this is the number I'll take to my main answer. Taxable HRA is 1,08,000. Understood, everybody? Please remember, HRA exemption assessee will get only if assessee is paying rent, first of all. Alright, so this is it with my 6th subdivision HRA adjustment. Then comes the 7th adjustment. Conveyance, what happened? 1 minute. Here. Conveyance allowance of 1,500 per month by the company towards actual reimbursement of conveyance spent on official duty. So how much conveyance allowance assessee received? 1,500 into 12, which is 18,000, guys. Now listen to me. Listen to me, everybody. See, if it is traveling allowance, connected to traveling is conveyance allowance. Another T, which is the transfer allowance. Then D, how are you? D for daily allowance. H for helper allowance, also called as servant allowance, also called as personal assistant allowance. R for research allowance, also called as academic allowance, and U for uniform allowance. Now these allowances, totally 7 guys: traveling allowance, conveyance allowance, transfer allowance, and D, how are you? So these 7 allowances, we'll see how much is received, how much is exempt, and the balance will be taxable. How much is going to be exempt? But whatever my assessee has actually incurred for official purposes, this is going to be exempt, guys. So conveyance allowance is what they're talking about in this question. So it falls under the same category. So how much did my assessee receive? My assessee received 18,000 over here. How much is exempt? Whatever assessee has incurred for official purpose. The question says this 18,000 is towards reimbursement of conveyance spent on official duty. So this amount is entirely spent for official purposes. So full 18,000 will be exempt. So nothing will be taxable. Understanding. So when it comes to conveyance allowance, my assessee has received how much? 18,000. And assessee has spent for official purpose full 18,000. So nothing is going to be taxable. All right. Then coming to the next adjustment, loan of 2 lakhs was taken from the employer on 1st July 23. Loan from employer on 1st July, not 1st April, 1st July. So only 9 months calculation for medical treatment of his brother for tuberculosis treatment. Interest charged on such loan is 5%. Entire loan is outstanding on 31st March 24. No medical insurance has been taken for his brother. SBI rate of interest was 11%. Which adjustment is this? Loan at concessional rate of interest, that adjustment, guys. Why do I say that? Because see, SBI lending rate on 1st April of the year, we're supposed to see on 1st April only, right? SBI lending rate on 1st April is 11%, but employer is charging only 5%. So my employee got a concession of 6%, benefit he got, guys. So this is loan at concessional rate of interest. The benefit over here is 6%. SBI lending rate is 11%, but assessing has to pay only 5%. So assessee got 6% benefit. But I hope you know that in this particular perquisite, there are 2 situations where assessee enjoys full exemption. There are 2 situations where assessee enjoys full exemption. Situation number 1 is, we will look at the aggregate original loan. If the aggregate original loan is within how much? If the aggregate original loan taken by the assessee is within 20,000 rupees, then the entire perquisite is exempt, guys. Also, if the loan is taken for medical treatment of a Rule 3A disease, then also it is exempt. Here, if you see, the loan amount is 2 lakhs, guys, which is more than 20,000. So, first situation is not applicable. But is the loan for medical treatment of Rule 3A disease, guys? It is for treatment of tuberculosis. They did not say whether it is Rule 3A disease or not. I'll make the most obvious assumption. I'll assume it is a Rule 3A disease. So, if I assume it is a Rule 3A disease, any amount of loan, even if it is more than 20,000, if it is for medical treatment of Rule 3A disease, it is fully exempt, guys. So this perquisite over here is going to be fully exempt. Alright, and the question also says no medical insurance has been taken. I hope you are aware of this adjustment. If medical insurance was taken, then you have a slightly different tax treatment. If medical insurance was taken, assessee is getting 2 benefits. One benefit from the employer, one benefit from the medical insurance company. So to the extent of the double benefit, on that double benefit amount, how much is the interest my assessee is saving? That will get taxed. But all that will come into the picture only if assessee is getting medical insurance. The question is assessee is not getting medical insurance. So therefore, nothing to be taxed about this as well. You understood the point, guys. So therefore, over here, if you see, Yes, assessee is getting a benefit. Market rate is 11%, but employer is charging only 5%. So 6% concession assessee is getting a benefit. But however, it is for medical treatment of Rule 3A disease, therefore it's going to be fully exempt. See, both points don't have to be fulfilled. Any one point. Either the aggregate original loan is within 20,000 or it is for Rule 3A disease. Any one fulfilled, it will be exempt. Here it is for medical treatment of Rule 3A disease, therefore it is fully exempt. Alright, so we have loan at concessional rate of interest. It is for medical treatment of Rule 3A disease, therefore it is fully exempt. But see, this adjustment, I don't want to stop right here because I'm not sure how well you understood the medical insurance point, and I also don't know whether you know about all the intricacies involved in this or not. So let me discuss this perquisite with you entirely because there are so many hidden points over here, and if we're doing the discussion, we might as well do a rank holder level discussion. See, listen to me. We are talking about loan at concessional rate of interest, or the same provision will also apply for loan which is given by the employer at no interest. So here, what is a perquisite? What is the benefit which my employee is enjoying? Loan is not the benefit because loan assessee anyways has to repay. The perquisite over here is the concession in the interest. In the interest, whatever discount the assessee, whatever employee is getting discount in the interest, that is a perquisite for the assessee over here. That is the benefit. Okay. Now the first point over here, you will see what is the purpose of the loan. Is the purpose of the loan medical treatment of a Rule 3A disease? If it is if the purpose of the loan is medical treatment of Rule 3A disease, then I don't care about the amount of the loan. The entire perquisite will be as it is fully exempt. It's going to be as it is fully exempt. Okay. Now, but then, however, let's go a little deeper. Who is the patient over here? Who is suffering from the disease? Who is the patient over here? The patient can be either the assessee himself, or the patient can be the assessee's dependent brothers or sisters, or the patient can be assessee's children, or the patient can be assessee's dependent parents, or the assessee or the patient can be assessee's spouse. So patient can be assessee or his dependent brothers and sisters or his dependent parents or his children or his spouse. Okay, so if any of them are suffering from Rule 3A disease, for that medical treatment, if the employer has given a loan at a concessional rate of interest or at no interest, the perquisite is going to be fully exempt. Doesn't matter what the amount is, it's going to be fully exempt. Okay, then comes the second exception. You will look at the amount of the loan. What is the amount of the loan? You will look at the aggregate original loan. See, you will not see the purpose over here. You will see the aggregate original loan. Is it within 20,000? If it is within 20,000, it's going to be fully exempt. Please remember that both of these are independent criteria. They are independent criteria, which means if any one out of these two are fulfilled, if the loan is for medical treatment of Rule 3A disease, or if the aggregate original loan is within 20,000, then the perquisite is going to be fully exempt. Okay, guys. So this is basic discussion. This is something which everybody will anyways be aware of. But what is the extra value add that I'm going to give you through this discussion? That's going to be my next 5 to 6 scenarios which I'm going to show you. These 5 to 6 scenarios will give you a 360-degree understanding of the entire concept. Alright guys, listen to me as carefully as you can. See, if let us say the employer has given the employee a loan of 2 lakh rupees, okay, at let us say 2% per annum interest. Alright. But however, what happened is on 1st April 2023, when our year began, out of this 2 lakh rupees loan, the outstanding amount was only 15,000 rupees, guys, which is within 20,000 rupees. And let us say the SBI lending rate on the 1st April of the year, SBI lending rate was, let us say, 5% per annum. Now my question to you is the perquisite going to be taxable? Yes or no? If yes, compute the amount. See, the outstanding loan amount is within 20,000. So can I say it is exempt? No. No, guys. Listen to me. We are looking at the aggregate original loan. We're looking at the original loan. We are not looking at the outstanding loan. Are you listening to me? We are not looking at the outstanding loan. We are looking at the original loan. Is the original loan within 20,000, guys? No. Understanding, we are supposed to look at the original loan. It is 2 lakhs. It is more than 20,000. So first of all, yes, it is going to be taxable. So outstanding loan can be less than 20,000. Doesn't matter. The second exemption over here is if the original loan is within 20,000. Original loan is more than 20,000, no exemption. It is also not for medical treatment of Rule 3A disease, no exemption. It is taxable. But how much will be taxable, guys? What is the benefit my assessee got? 5% is the SBI rate. Assessee is paying only 2%. So 3% is the benefit which the assessee got. But 3% of what? You will always calculate interest as a percentage of the outstanding loan only, right? So 15,000 into 3%, which is going to be 450 rupees. This is what your taxable purpose it is going to be. Did you understand my first point over here? Yes, guys. So this discussion right now is focusing on the point that you're supposed to look at the original loan, not at the outstanding loan. You're supposed to look at the original loan. Original loan is more than 20,000. It is a taxable perquisite. So 3% is a benefit is what my assessee is enjoying. So percentage always of the outstanding amount only. So 450 becomes a taxable perquisite. All right. Now listen to my second situation. In the second situation, again, the employer gave a loan to the employee, okay? This loan was for 15,000 rupees only, okay? Then what happened is a little later, employer gave another loan, the second loan to the employee, and this loan was for 6,000 rupees. Notice very carefully, each loan is within 20,000 rupees. Now my question to you is it going to be a taxable perquisite or an exempt perquisite? See, are you supposed to look at each loan separately? No. We said aggregate original loan. Aggregate loan, guys, not separately. So you're supposed to look at all the loans together. You're supposed to look at the aggregate loan. So the aggregate loan is 21,000, which is more than 20,000, guys. So definitely this is going to be taxable. You're getting my point. So through the first point, I'm trying to stress on the point that you're supposed to look at the original loan, not the outstanding loan. So the second point, I'm trying to stress upon the main point that you're supposed to look at the aggregate loan and not each loan separately. These little points, these are the points which, will help you ace your intermediate level examination. These little points, are you noticing? Within one perquisite itself, there are so many hidden points. All this is what I want you to be aware of. Okay, now listen to the third point, guys, my third situation for you. This time employer again he gave a loan to the employee. Okay, this loan was for 25,000 rupees. All right, and this loan was given on 1st June 2023. This loan was given, let us say, at 5% per annum interest. Okay. Now, what about the SBI lending rate? SBI lending rate, I'm going to give you on 3 dates. On 1st April 23, let us say it was 8%. On 1st June 23, let us say it was 9%. On 31st March 24, let us say it was 10%. My question to you is, and one more thing, this was a housing loan. Okay, so my question to you is it going to be a taxable perquisite? If yes, compute and tell me the taxable amount. How will your thinking be? Come on, go step by step. Tell me, is a loan for medical treatment of Rule 3A disease? No, it's a housing loan. Is the original, aggregate original loan within 20,000? No, it is 25,000. So first of all, it is going to be a taxable perquisite, guys. But SBI lending rate, 3 numbers are given to you. Which one will you pick? You will always pick the 1st April number, 8%. How much is my employee paying? Only 5%. So 3% benefit he got, guys. What is the outstanding amount? Full 25,000, nothing is repaid. But into how many months? 1st June only the loan was given, right? So June, July, August, September, October, November, December, Jan, Feb, March. For 10 months only you will calculate. Understood, everybody? Yes. So this is going to be 625. This will be your taxable perquisite. June onwards only you will calculate. And SBI lending rate on 1st April of the year is what you're supposed to consider. All right. Now listen to my next point, my fourth situation for you. In the fourth situation, again, employer gave a loan to the employee, housing loan, 25,000 rupees, 1st June, 5% per annum. But let us say SBI lending rate, you know now you're supposed to take SBI lending rate on 1st April of the year only, was let us say 2%. Now tell me, will anything at all be taxable over here? Will you tax anything at all? See, just because you see one difference, don't tax it. SBI lending rate is 2%, employer is charging 5%, guys. So did the employee actually enjoy a benefit? See, when does employee enjoy a benefit? Only if SBI rate is high. Employer is charging small amount. Employer is giving discount. That is when employee enjoys a benefit, guys. But here if you see, SBI rate is only 2%. But my employer is charging 5%. Assessee is paying more than the market rate. So here there is no benefit. Nothing at all is going to be taxable. So this situation teaches you that just because you see one difference in the interest rate, don't straight away tax the difference. Check is the employee actually enjoying a benefit or not, only then tax it. Okay, everybody. Then listen to my 5th scenario, okay? Don't lose patience. Just 2 more scenarios I will discuss with you. With that, we will be done with this work visit. See, in my 5th scenario, again, the employer gave a loan to the employee. But this time, this loan was for medical treatment of Rule 3A disease. Okay, and who is the patient? Patient is like what I told you already, assessee, or his dependent brothers and sisters, or his dependent parents, or his children, or his spouse. Now tell me, will the perquisite be taxable? No, medical treatment of Rule 3A disease will be fully exempt. I don't care about the amount or purpose. Any one fulfilled, it's going to be exempt for me. Alright, so this was my 5th scenario. Now listen to my 6th scenario, my most important scenario, guys, the scenario which will help you understand the medical insurance point properly. Take it as a challenge. In the first explanation itself, you should understand it is not a difficult adjustment, guys. I will simplify it for you to the best of my ability. You just listen to me carefully, sit up straight, no background music in your minds. Just give me your 200% for the next 5 to 6 minutes. One explanation, you will get sorted. Okay, ready? Listen to me. So in the scenario 6, what happens is, again, employer gives one loan to the employee. Okay, now this loan is 25,000 rupees, let us say, and this loan was given at 5% on 1st June 2023. And what is the SBI lending rate on 1st April 23? Let us say it was 8% per annum. So clearly my employee is enjoying a benefit. 8% is a market rate, but employer is charging only 5%. So no doubt employee is enjoying a benefit. But what is the purpose of the loan? Purpose of the loan is medical treatment of Rule 3A disease. So if I stop right here, what will your answer be? If I stop right here, you will say, ma'am, it is medical treatment of Rule 3A disease. I will not care about the amount. It's going to be fully exempt. That is what you would say, guys. But I'm not ending my story here. I'm adding one more point. On 1st Jan 2024, the medical insurance company gave some medical insurance compensation to the assessee. How much compensation? Let us say 8,000 rupees. And the employee has decided to keep this compensation also. So which means, do you agree first of all that my employee has enjoyed two benefits for the same disease, guys? For the same problem, he got one benefit from his employer. He got 3% discounted loan he got. He got benefit from employer. Second, he got medical insurance compensation also. So for the same issue, he got two benefits. Now income tax is not going to give you exemption. See, listen to me now. You got two benefits. So because you got two benefits, there will be some taxation. There will be some taxation. Till here you understood? Assessee got two benefits. There will be some taxation. Now how to calculate? See, what is the loan amount? The loan amount is 25,000. This 25,000 loan amount, I will split into two parts. What am I splitting? I am splitting the loan amount into two parts. The first part will be the extent to which I got double benefit. The extent to which I got double benefit is the 8,000 loan, guys. See, I'm not talking about the 8,000 insurance compensation over here. I'm talking about the 8,000 loan. The loan is what I'm splitting into two parts. To the extent to which I got double benefit, to that extent, and the balance loan, 17,000 loan. Now tell me, this 17,000 loan, did I get any double benefit? No, here I did not get any double benefit. So this was exempt, continues to be exempt, guys. Yes, where did I get double benefit? Only to the extent of this 8,000 loan I got double benefit. This 8,000 rupees I got loan from employer also. I got medical insurance compensation also. You're understanding? This 8,000 rupees loan, why am I calling it double benefit? Because I got this 8,000 rupees loan from the employer also. 8,000 rupees I got medical insurance compensation also. So this 8,000 rupees loan, to this extent I'm getting double benefit. So on this double benefit, I will not enjoy exemption anymore. This double benefit will become taxable. So what will the taxable value be, guys? 8,000 rupees is a loan amount. On this, how much interest discount are we getting? 3% interest discount we are getting. And for how many months, guys? See, the taxation is coming into the picture only when I got the double benefit. Double benefit I got only when I got the insurance compensation. Insurance compensation I got only in January. So Jan, Feb, March, for 3 months only, I will do the calculation. This is going to be how much, guys? This will be 60 rupees. So this will become my taxable perquisite. You're understanding? So the loan amount I'm going to split into two parts. The loan amount to the extent of which I got the double benefit and the balance loan amount. To this extent, I did not get any double benefit. So this was exempt, continues to be exempt. But this portion, yes, I got double benefit. I got loan also. I got medical insurance compensation also. So on this part of the loan, I will lose the exemption. But when will I lose the exemption? Only when I got the second benefit. Second benefit I got only on 1st Jan. So only for 3 months I will do the calculation. This will become the taxable value. You're understanding? In this question, no such drama because no medical insurance. But you got the point right. Had there been medical insurance, you would have seen what is the extent of the double benefit. On the double benefit, you would have had taxable value. Here there is no medical insurance, so therefore no double benefit. So loan is for medical treatment of Rule 3A disease, fully exempt. Alright, now I'm content that whatever adjustment you get in the exam relating to this whole this loan perquisite, I can give you an assurance. For sure you will be able to handle. These 6 scenarios which I've given you cover everything that is possible from this particular adjustment. Hello everybody, feeling confident? Yes, come on, let's go forward. Let's go to the 9th adjustment, guys. Yes, 9th adjustment. Just 2 more adjustments. Come on, let's finish them. Free education was provided to the sister of Mr. Anshul in a school maintained and owned by the company. Tell me, is it education allowance or is it education facility? Oh, wait. Let me confuse you a little bit. Is it education allowance? Is it education reimbursement? Or is it education facility? Which of the three? See, education was provided in a school which is owned and maintained by the employer. So this is not education allowance. It will be allowance only if they use the word allowance. They're not using the word allowance. It is not reimbursement. Employer is not just reimbursing the fee. It's a facility. If it is in a school which is owned or maintained by the employer, it does become a facility. Okay, so it is an education facility. And education facility, you check 1,000 rupees per month per child exemption, you check, right? But all that you check only for assessee's own children. Who is studying over here? Assessee's sister is studying over here. So that 1,000 rupees per month per child exemption which you think about, that will not be applicable over here. Guys, don't get confused. I am not talking about children education allowance, 100 per month per child, maximum 2 children. I am not talking about that. I am talking about the education facility exemption. Here you must have learned, no, that the reasonable cost of education in a similar school, in a similar locality is up to 1,000 per month per child, then nothing is taxable. That exemption is only if the student is assessee's own children. Your assessee's sister is studying. So therefore, I will not think about that exemption. The entire 900 per month is going to become fully taxable. All right. So coming back to my main answer, we have education facility over here. How much is it? 900 per month. So this 900 per month is going to be fully taxable. I will not compare it with 1000 per month per child because that exemption I will give only for assessee's own children. All right, and finally, guys, the last adjustment, LTC adjustment, LTC given to Anshul, his wife, and three children. But maximum how many children allowed? Only two children allowed, guys. But the three children are one daughter aged 6 years and twin sons aged 4 years. So the elder child is one single child, the younger child is multiple born. So totally my assessee is having three children. You know very well, if the younger born is multiple birth, we don't care about the two children exemption. So how many ever children are there, for all the children assessee will get exemption. Right guys, I'll repeat once again. LTC you get exemption for maximum two children only. See, listen, I'll give you one small tip over here, okay? In your syllabus, where and all do you have the two children limit? Number one in LTC. Then number two in children education allowance, 100 per month per child, maximum two children. Number two, children hostel allowance, 300 per month per child, maximum two children. And number four, you have the two children limit even in tuition fees. Section 80C, tuition fees for education in India, maximum two children, assessee's own children. Okay. Nowhere else you have the two children limit. Clubbing, minor child clubbing, 1032, 1500 exemption you give, no two children limit. Education facility, assessee's own children getting educated, 1000 per month per child exemption you have, no two children limit. Two children limit you have only in these four places. So we are talking about LTC, guys. So LTC maximum two children only. But that two children limit itself does not apply if assessee has multiple birth in second child. So second born of the assessee is multiple birth, twins. So total is more than two. It's okay. Assessee will get exemption for all children. Generally, assessee will get exemption for only two children. But if first child is single birth, second child is multiple birth, in that case, even if you have more than two children, you will get exemption for all children. And remember one more thing: if assessee is giving if the employer is giving the assessee under LTC, travel tickets also, let us say, employer is bearing, and even hotel expenditure employer is bearing, then in that case, only the travel portion is going to be exempt. The hotel portion is going to be taxable. Right, guys? So LTC exemption you will get, but only for the travel portion and not for the hotel portion. Okay. So here, if you see LTC for wife and three children, daughter aged 6, twin sons aged 4, it's okay. I will give exemption for all the children. Cost of air tickets, economy class. Yes, it should be economy class only. It should not be business class. Reimbursed by employer is 20,000 for adults and lump sum 25,000 for three children. So yes, even though three children, all children I will cover because I've already told you about this. And see, only tickets, only travel is being reimbursed. So therefore, it's going to be fully exempt. Had it been hotel also, then the hotel portion would have been taxable. Anshul is eligible for availing exemption this year to the extent permissible. So basically, you know, right, in every block of 4 calendar years, 2 vacations employee can take anywhere in India with his family. So here they are saying all those conditions are fulfilled. So yes, even though assessee has 3 children, it's going to be fully exempt for the assessee. Why fully exempt? You understood, right? Because it is economy class. And even though there are 3 children, it's the first born is single child, second born is multiple birth. So in this case, even though you have more than 2 children, you get exemption for all children. And it's only travel reimbursement, it is not hotel reimbursement, therefore it is fully exempt. All right, that's all, guys. Add up what's the gross salary of the assessee. You see, gross salary, how much are you getting? 15,67,240. Then you will get 50,000 standard deduction. And remember, we had professional tax also over here, 2,200. Full professional tax we will get deduction. So what is the net amount over here? The net taxable salary of the assessee is 15,15,040. All right. And professional tax, remember, one small thing. Listen to me. For example, okay, let us say professional tax is 2,200. Okay. Employer has paid, for example, 1,800. Employee has paid, let us say, 300. And the balance 100 rupees is still due. Then what will you do? Not paid. 100 rupees is outstanding. Then what will you do? In that case, whatever is paid by employer, this becomes a perquisite. This will be taxable, no change. But under section 16, how much deduction you will give? You will not give 2,200. Under section 16, you will give only 2,100. You're understanding? This question fully paid, guys. So this question full 2,200 I gave. Just making you think over here, if any part of it is outstanding, no. So that part you will not get section 16 deduction. You getting my point? Only whatever is paid, whether employer paid, whether employee paid, only whatever is paid only I will get section 16 deduction. Understanding? Yes, good question, guys. Lot of adjustments under salaries got revised for you through this question, especially that loan perquisite. That I'm sure, I so wish this perquisite comes for you in the examination now, because you know it so well. Whatever they ask you, you will be able to answer. Alright, guys. So we've done two full-fledged questions, question number 6 and 7. I'll close this session over here. In the next session, I will do the remaining questions for you. Alright, guys. Thank you so much. Bye-bye.